Good day, everyone. Our discussion for today will be centering on how the financial statement analysis affects the improvement or the success of your business plan. So there are different types of um, financial statements, and who are those people who need to have this financial statement analysis, and what are the importance of financial statement analysis to those people or to those group. Okay, so let us now discuss the financial statement analysis. For this chapter, we are going to define the financial statement analysis, identify the different users of financial statement, generate and analyze financial reports in the business, and recognize the different financial statement analysis methods. What is financial statement analysis? When we say financial statement analysis, this is a method of reviewing and analyzing a company's accounting reports. So accounting reports includes the financial statement that is able to gauge the past, present, or projected future performance. This process of reviewing the financial statement allows for better economic decision making. Okay, so because referring to your financial statement now as your basis for decision making, it really helps you to decide on what strategy you are going to use, especially if it is focusing on the economic or the financial stability of your business. What is the main purpose of financial statement? This is, of course, to analyze and utilize information about the past performance of the company to predict how it will fare in the future. Another important purpose of the analysis of financial statement is to identify potential problems, areas, and troubleshoot those. So the primary purposes of financial statement first is to predict the performance or the financial performance of your business. So your prediction will be based on your past performances of your business. Okay? Or if you're just starting, past performances of other businesses that you can refer into, the same business that your business will be going through. So another is to know what are the potential problems and to solve these problems. There are different users of financial statement analysis. This refer to the management of the company who analyzes financial statements to make decisions related to the operations of the company. These are the internal users. And when we say the external users, these do not necessarily belong to the company but still hold some sort of financial interest. And when we say internal users, these are individuals or team related to the management or within the company itself. When we say external users, these are groups or people that do not belong to the company, but still they need to have this financial statement in order for them to refer on. It depends upon their purpose about on why they are going to have this financial statement analysis. Maybe they will just use this as a reference for their future business expansion or decision in their business fields. Okay, so those are the two users of financial statement analysis. Okay, so another users of a financial statement analysis are the management. So this is under the internal users. So management, these are the managers of the company that use their financial statement analysis to make intelligent decisions about their performance. For example, they may gauge cost per distribution channel or how much cash they have left from their accounting reports and make decisions from this analysis results. This is a very important part of the management team. No, so the management team will use this financial statement in order to become the basis of their decision making especially in buying, storing, purchasing, procuring, and all. So also it also become the reference of their decision on how much cost they will spend for a certain activity, okay? Or the decision making on how much people they will hire based on the reports from the financial statement, okay? So this is very important for the management team. Next, number 2 are the owners. So again, these are included in the internal users. So small business owners need financial information from their operations to determine whether the business is profitable. It helps also to make decisions like whether to continue operating the business, whether to improve business strategies, or whether to give up on the business altogether. So as you can see, there are different purposes in accordance to the users. Now, of course, for the owners, financial statement is a big help for them because this will also serve their basis on to what strategies they were going to use of the decision if they are going to pursue still their business or not, and many other basis of their decision making regarding their business. Okay. Next, number 3 are the investors. So these people who have purchased stock or shares in a company need financial information to analyze the company on what way the company is performing. They use financial statement analysis to determine what to do with their investments in the company. And so depending on how the company is doing, they will either hold on to their stock or sell it or buy more. So they are the investors still under the internal users. For the creditors, the financial statement analysis serve as their basis in knowing if a company will be able to honor its payments as they become due. So they use the cash flow analysis of the company's accounting records to measure the company's liquidity or its ability to make short-term payments. So this group fall on the external users. So they are the ones who let the company borrow money to them, and then that's why they need to have this financial statement in order to check if the company has capability of paying back of the money that they borrowed from them. Okay. Number 5, the government. So for the governing and regulating bodies of the state, look at financial statement analysis in order to determine how the company is performing in general. So they can plan their financial and industry policies because of the financial statement analysis. Also, the tax authorities will also analyze a company's statement to calculate the tax burden that the company has to pay. The government falls under the external users. For the employees really also need to know or to see the financial statement analysis in order for them to be secure, no? Or if they have this possibility to have a higher pay. So they also want to know if the company is stable or profitable. And also, they are interested in knowing the company's financial position and see whether the plans for expansion or there will be plans for expansion. And of course, when there are expansions, of course, more profit, and they will be also be benefited from this. Okay? Because of career prospects. Okay? And they might also be having additional pay from this expansion, or not just only pay but promotion as well. Okay, number 7 is customers. So they are in need of knowing the financial statement analysis to know the ability of the company to service its clients in the future. So they need to know about the company's stability of operations, and heightened if the customer, for example, this distributor or procurer of specialized products, is dependent fully on the companies for its supply. Okay? So companies or customers are external users. So the employees are internal users. Okay, next, general public. So anyone is the public or the general public, like students, analysts, and researchers, may be interested in using a company's financial statement analysis. We wish to evaluate the effects of the firm on the environment or the economy or even the local community. For example, if the company is running corporate social responsibility programs for improving the community, the public may want to be aware of the future operations of the company. Okay, so corporate social responsibility is one of those strategies that the company should do in order for the public to know that they are capable of serving the public and they are profitable enough to do so or to do such activities as CSRs. Okay, so if the general public is informed about the performance of the company through the customer social responsibility or corporate social responsibility rather, because they have lots of programs at serving people, meaning to say that their financial statement is stable and they have this ample amount of investment or money to give for this activity. Okay? So this is not only about for the benefit of in one way around. So it is a win-win situation for the company and for the general public. Okay. Of course, general public is under external users. Okay, so now let's proceed to the methods of financial statement analysis. So we have here the horizontal or trend analysis and vertical analysis. Again, we have horizontal or trend analysis and then the vertical analysis. When we say horizontal analysis, it is the comparison of financial information of a company with historical financial information of the same company over several reporting periods. So it could also be based on the ratios derived from the financial information over the time span. So the main purpose is to see if the numbers are high or low in comparison to past records, which they can also be used to investigate any causes for concern. Okay, so this is an example of horizontal analysis of financial statement. Okay, so as you can see, the financial statement or activity or performance are plotted within different years, no, in order to see the progress or the performance of the company. Okay, so for example, 2012, the revenue of Apple is 156,508, and then it decreases on 170,910 on 2013, and then 2014 it increases, 2015 it increases, and then 2016 it decreases again. So you can see the performance per year, and then you can compare. And then for that comparison, you can do certain ways on how to resolve the problem or to see what are the problems and to troubleshoot those problems. No? Maybe you can add some marketing strategies, or you can less your expenses. Okay. So another example here is from Google. Okay. So you can see the different performance, the revenue, gross profit, R&D, and as well as the different years of their performance, okay, as well. So this is an example of horizontal analysis of financial statement analysis. Okay, next, we have the methods of financial analysis, statement analysis that is under the horizontal analysis. So we have the absolute comparison and the percentage comparison. When we say absolute comparison, this is about comparing the absolute currency amounts of some items over a period of time. So when we say percentage comparison, this is percentage differences in certain items are compared over a period of time. So absolute, it means currency or absolute currency amounts, whereas in percentage, the differences are being measured through percentage differences. Next, let's go now to the vertical analysis of financial statement. So this is conducted on financial statements for a single time period only. Typically, this analysis means that every item on an income and loss statement is expressed as percentage of gross sales, while every item on a balance sheet is expressed as a percentage of total assets held by the firm. So vertical analysis is also called static analysis because it is carried out for a single time period. So let's have the example. Okay, so we have here the example. So as you can see, compared to horizontal analysis, vertical analysis only focus on a single year and the performance of a certain company for a single year or for that year alone. Okay. So now let's go to the key financial statements and how they are being analyzed. So they are being analyzed through balance sheet, the income statement, and the statement of cash flow. For the balance sheet, it shows the current financial position of the firm at a given single point in time. It is also called the statement of financial position. The structure of the balance sheet is laid out such that on one side, assets of the firm are listed, while on the other side, liabilities and shareholders' equity is shown. Okay. So for the balance sheet, we have the current assets, long-term assets, current liabilities, okay, long-term assets. Okay. So again, for the balance sheet, we have the current assets, the long-term assets, and the current liabilities. Okay, for the current asset, it is held by the firm, referred to cash and cash equivalents. So these cash equivalents are assets that can be easily converted into cash within 1 year. Current assets include marketable securities, inventory, and accounts receivable. For long-term assets, we have the so-called non-current assets and include the fixed assets like the plant, equipment, and machinery and property. For the current liabilities, these are obligations that are due in less than 1 year. So this include accounts payable, deferred expenses, and also notes payable. For the long-term liabilities, these are financial payments or obligations due after 1 year. These include loans that the firm has to repay in more than a year and also capital leases which the firm has to pay for in exchange for using a fixed asset. We have also the shareholders' equity. It is known as the book value of equity or worth of the firm. It is the difference between the total assets owned by the firm and the total liabilities outstanding. It is different from the market value of equity, which is calculated as the number of shares outstanding multiplied by the current share price. And then we have this debt equity ratio. It is also called a leverage ratio, and it is calculated to assess the leverage or gearing of a firm to show how much it relies on debt to finance its activities. So this ratio has pertinent implications for the financial health of the firm and the risk and return of its shares. Next, we have the current ratio. So the current ratio helps investors and creditors to understand the liquidity of a company and how easily the company will be able to pay off its current liabilities. So that's current ratio. And then we have the quick ratio. The quick ratio measures a company's ability to meet its short-term obligations with its most liquid assets and therefore includes inventories from its current assets. It is also known as the acid test ratio. So this is an example of a balance sheet. Okay, so you have different parts here. Okay, and then this one. So the balance sheet should be balanced. The assets and the liabilities should be balanced. Okay. Next. They are being analyzed, or the financial statement are being analyzed through also the use of this income statement. So the purpose of an income statement is to report the revenues and expenditures of a firm over a specific period of time. It was previously called as a profit and loss account. So for the income statement analysis, you need to analyze the profitability ratios. So under profitability ratios, we have the net profit margin, which is, this is a ratio that calculates the amount of profit that the company has earned after taxes and all expenses have been deducted from the net sales. So meaning to say all the expenses are being deducted from the revenue. So you have this net profit margin. And then we also have the return of assets, or the ROA. So this ratio shows the percentage of profit a company earns in relation to its overall resources. So that's ROA, or return on assets. Okay. Next, return on equity. This ratio is used to calculate company profit as a percentage of total equity. For the valuation ratios, we have the price to earning ratios, which is used to evaluate whether the value of stock is proportional to the level of earnings. So it can generate for its stockholders. So it assesses as well whether the stock is overvalued or undervalued. So that's what we call the price to earnings ratios. This is an example of income statement. Okay, so you have here the following data about the following parts. And then for the last, they have this net income. Okay. So that's it for our discussion for today about the financial statement analysis. So I hope you learn for some of the concepts involving this topic. No, when you are going to do your financial report, I hope this will help you very much. Okay. So again, thank you everyone, and stay safe and healthy.